Reconciliation simply means getting something to agree. In our case, we're looking at getting accounting records to agree. We can do an internal reconciliation by looking at our own accounting records where we've got duplicates of the same transactions. In other words, if we look at our control accounts versus the individual accounts in the subsidiary ledgers and we add them together to get a list, the debtors ledger list should have the same total as the debtors control balance, for example, because both of them have exactly the same transactions that have been included. The first thing to do when deciding how to fix a mistake is determine where was the mistake actually made. If the mistake happened in the source document or the journals, that means that the mistake would have followed through to both the control account and the subsidiary ledger. And so therefore you would need to fix both. If, however, the error took place only in posting to the debtors or creditors ledger, then you would only need to correct your list of debtors or creditors or in the individual accounts of the debtors or creditors ledger. If the mistake was made in totaling the journals or posting to the control account, you only need to fix the control account. Note that the journal totals only go to the control account because the subsidiary ledgers are usually posted daily as each transaction takes place. External reconciliations can be done with any information that we receive from a party outside the business that is part of the same transactions. For example, our bank or creditors. So if we receive a statement from the bank or a statement from our creditors, we can then compare that to our internal records of the bank account or of our creditor's ledger account for that creditor. The first thing we would do is update our records with any information that is on their statement and we haven't yet used. So this would include things like maybe if they charged us interest or there was a return that they have now approved that we didn't know that they're approved, or anything like that. If there's any information that is on the statement received from someone else and we don't know about the information, we update our records. If you're doing a bank recon, very commonly it would also include things like payments from customers. I actually do all my recording of payments from customers by looking at my bank statement and simply uploading the information from there. You might identify errors along the way where you see that there are discrepancies and you can't find a valid reason for it. It is possible that there might be fraud, but this is not the main reason of doing a reconciliation. Just like auditing, the main purpose is not to find fraud. However, fraud might be encountered, and obviously if it looks very scary, then you pull in the forensic auditors. Not all errors are fraud, again, obviously. One needs to allow for human error. The thing is, if there's a mistake, you'll need to go and find out who made the mistake, because whoever made the mistake is the one who's going to have to go and fix it. So if you've got one amount on your records in the creditor's ledger and there's a different amount on the creditor's statement, I would suggest that the first thing you need to do is go back to the invoice and have a look and see what is the actual amount on the invoice. And then from there, you can go and record the correct amount, either in your records or contact the supplier to say, please update your statement. If you are wanting to tell the creditor, these are the differences, obviously you can just send them an email or you can pick up the phone and tell them. But at the same time, we want to keep some kind of record of it. Obviously, we can't actually update their statement. So what we do instead is we update their statement by creating a reconciliation. Our recon statement is simply an extension of the bank or the creditor statement, showing this is what we want them to do. And next month we would check, have they actually recorded it or not? So this is what you would do. You would first compare the bank statement and your business records. Everything that is the same, you just tick them off and you don't need to do anything with them. But anything that is on the statement received from another party that we don't know about, we will use to update our business records. And then anything in our business records that is not on the statement, we will put onto the reconciliation statement or a remittance advice. A remittance advice is simply a little piece of paper. Sometimes it'll actually be printed on the statement already that you could then send to the creditor explaining these are the things that I disagree with, and this is why I've paid the amount that I actually have. Something to keep in mind when you are doing external reconciliations, even internal reconciliations, is you want both entries to be exactly the same. Both records should have the identical information on it. It's kind of like if I had to give you and your friend each a little pile of Smarties, but I don't count them out or check the colors, obviously you'll be unhappy because one of you might have more and the other one might have your favorite color. The way that I would fix it, obviously I can't take your Smarties away from you, you'd be very unhappy, but we could add to those piles. And we simply add to each pile until you've both got exactly the same. That is what we do with our reconciliations. You add from the creditor statement so that you've got everything they know about. And then you add from your records onto the recon statement so that once they have taken into account everything on the recon statement, they would have exactly the same information as you. At the same time, we need to also look at how we manage our debtors, our customers. The first thing is to make sure that we have an airtight credit policy. Of course, it's possible to go into business and not really think about it and just happily offer credit to everybody. But if you don't give it some careful thought and planning, then your customers won't know how long do they have to pay you back. You might give them unlimited credit and then suddenly you realize, oh gosh, they can't actually pay you back at all. You might want to do credit checks on them by getting credit references or something. You also want to think about, are you going to offer them discounts? Are you going to charge interest? And ideally, this should all be put down in a credit policy that you're aware of. Things like when you're going to accept a customer to have an account that you're going to offer them credit, go and do a little credit check. Go and see, have they got references that you can chat to and find out, do they actually pay on time, etc. Make it very clear. These are my terms. This is when you need to pay by. This is the maximum amount that you can take out on your account. And obviously over time, those can be improved as they develop a good credit rating with you. If you've got good credit control, because now notice the policy is not the same as the control. It's all very well developing a policy, but if you never follow that policy and you never actually control what's happening, it's pointless. It might as well not even be there. So on the one hand, you create your policy, but then as time goes on, you need to do very careful credit control to check that your customers are paying you when they should. Obviously, yes, you can offer discounts, you can charge interest. In reality, that isn't actually as effective as simply keeping them up to date with what they owe you and contacting them when they are overdue. You can just send regular statements, a little reminder, might be an email, a WhatsApp, even pick up the phone and speak to them. That is the best way to actually get people to pay you pretty quickly. Also, what you can do is if they are not paying you in spite of all of those efforts, it's quite simple. You just don't give them anything more until they have paid. So restrict their account, put a limit on it and say, sorry, until you've actually paid this amount, you can't have any more credit. Especially if they are desperately wanting something you've got, you'll see that money come in very quickly. Something that can help us to control our debtors is creating an age analysis. Now, in reality, obviously, QuickBooks is wonderful. Just like QuickBooks can suck out the information from my bank statement about who's paid me and update my customers, in the same way I can press a button and it will actually create a little age analysis of debtors. However, it's important for you to understand what goes into this and how it's created so that you can then better understand and use it. basically what you do is you've got columns showing how old is the debt, and you've got rows for each of your debtors with a total at the bottom. Sometimes you might be asked just to do the totals. Sometimes you'll just be asked to do for one debtor. But the important thing is just make sure that you lay it out clearly and you understand what is actually required here. One of the first things that I always like to do is identify my months. These months that I've got written in brackets are not going to be there for you, but they help a lot. So if, for example, I've received a statement that is dated the 30th of April, and now I need to create an age analysis of my creditor, or it might be that I've created a statement for my customer and I want to do an age analysis for my customer. If the date is the 30th of April, that means April will be my current month, assuming my terms are 30 days. Current means that these entries took place within the current terms, and they are not yet overdue. If you're working month to month, you can then just say, well, obviously 30 to 60 days must be the previous month. So what comes before April? March. And then February comes before March, and January comes before February. And once you've laid all of those out, it means when you are entering the invoices, all you have to do is look at the invoice date and pop it in the correct column. If interest has been charged or there's any other charge that takes place, it would be entered in the month that you charged the interest, not the original amount that was overdue, but only when you charged the interest, because they didn't owe that interest from the very beginning. They only owe it from whenever you actually charged it. So put it in that month. So that's how you would enter all the invoices. You can see over here, debtor 1 has got quite a few things outstanding. Debtor 2 is horrendous. Debtor 3 is fine. They're a good debtor. We like them because everything is settled. They've only got a current balance. We can then show our returns and our payments. Notice that our returns will be offset against the most recent purchase. So, for example, this entry over here must have been a return because those amounts are still outstanding. This must have been a return that took place during March. Payments, on the other hand, are used to offset the oldest amount. So debtor 1 and debtor 3 have made payments to clear out the amounts that they owed from the original oldest amounts that they owed. And then obviously you can do a total and see how much everybody owes you. The last thing that you can do is ratio analysis. You already know how to calculate your debtors collection period, your creditors payment period, etc. Compare those to the terms. As soon as they tell you debtors have terms of 30 days or whatever it is, compare how long are they actually taking to what the terms are. And combined with your debtors age analysis, it'll help you to see, do you have a problem or not? You can do exactly the same with the creditors payment period and compare that to the terms. You want to pay creditors in time. You don't have to pay them immediately. It's quite nice to have a little bit of time to pay them. If they offer a discount, then yes, use that period that is early because discounts can save you a little bit of money. Obviously, if you don't have cash flow, you can't. But do not pay your creditors late, because if you do, it can jeopardize your relationship with your suppliers and it can become very problematic. You suddenly need to place an urgent order and they say, so sorry, we can't supply you until you pay. And now what? Also, if you need to ask them for a favor, they're not going to be as willing to suddenly do a rush order for you because they're going to go, why bother? You're not going to pay me in time. You can also compare your debtors period to your creditors period, because if you're able to get the money from your customers sooner than you have to pay your suppliers, it means you've got a slightly more positive cash flow. Remember, we looked at this in analysis. You would ideally also want to compare it to your inventory period. But even if you've just got debtors and creditors, have a look at that comparison. It's very useful.